Today, we will talk about dual-class stock, including its structure and controversy. A dual-class stock is when a company issues two share classes. A dual-class stock structure can consist of Class A and Class B shares, for example. These shares can differ in terms of voting rights and dividend payments. When multiple share classes of stock are issued, typically one class is offered to the general public, while the other is offered to company founders, executives, and family. The class offered to the general public often has limited or no voting rights, while the class available to founders and executives has more voting power and often provides for majority control of the company. Dual-class stock is designed to give specific shareholders voting control. Classes of stock with unequal voting shares may be created to satisfy owners who don't want to give up control, but do want the public equity market to provide financing. In most cases, these so-called supervoting shares are not publicly traded, and company founders and their families are most commonly the controlling groups in dual-class companies. Well-known companies, such as Ford and Warren Buffett's Berkshire Hathaway, have dual-class stock structures, which provide founders, executives, and families the ability to control majority voting power with a relatively small percentage of total equity. The New York Stock Exchange banned dual-class structures in 1940 after an outcry in 1926 over automotive company Dodge Brothers' public offering, which consisted of non-voting shares for the public. However, the exchange reinstated the practice during the 1980s in the wake of competition from other exchanges. Once shares are listed, companies cannot reverse any voting rights attributed to the new class or issue any classes of shares with superior voting rights. In recent times, the number of companies opting for a dual-class structure during listing has multiplied. Dual-class stock structures are controversial. Their supporters argue that the structure enables founders to demonstrate strong leadership and the placing of long-term interests over near-term financial results. It also helps founders retain control over the company, as potential takeovers can be avoided through their supermajority voting shares. On the other hand, opponents argue that the structure allows a small group of privileged shareholders to maintain control, while other shareholders provide the majority of the capital, leading to an unequal distribution of risk. Academic research has proved that powerful classes of shares for insiders can actually hinder long-term outperformance. Alphabet subsidiary Google is the most famous example of a company with a dual-class structure. When it was listed in 2004, the search giant unveiled two classes of shares in its offering. Class A shares were reserved for regular investors and had one vote per share. Class B shares were reserved for founders and executives and had 10 times as many votes as those for the ordinary A shares. Many investors were frustrated at this initial public offering, given that the internet giant boasted a market capitalization among the top 30 firms worldwide. Other examples of companies with dual-class structures are Meta, Zynga, Groupon, and Alibaba. Here are 4 key takeaways. 1. A company or stock with a dual-class structure has two or more classes of shares with different voting rights. 2. Typically insiders are given access to a class of shares that provide greater control and voting rights, while the general public is offered a class of shares with little or no voting rights. 3. Supporters say these types of structures allow the people who founded and currently run the company to think long-term, rather than be at the mercy of shorter-term oriented investors who want to see bigger profits right away. 4. Dual-class structures are controversial because they do not allow public shareholders a say in running the company and distribute risk unequally. Hope this would help. Thanks for watching.